So the biggest downfall with doing an interest in advance loan is the rates. We've done the interest in advance loan in 2025, the rates were 6%. Now it's 2026, and guess what? The rates dropped 25 points. So before I break it down, I want to tell you what an interest in advance loan is. This is generally done if you earned a massive income, bonuses, commission for that financial year. You're not going to earn as much of an income the following financial year. I just received a $150,000 commission check. I should be happy, but guess what? I still got a big tax liability. I just helped one of my clients reduce their tax liability by just under $45,000. And I'll show you how I've just done it. I'm your host, Tony Shah, and thanks for joining me on another episode of The Mortgage Chat. So how did I just help my client reduce his tax liability by just under $45,000? So before I break this down anymore, I want you to understand this is going to be a first world problem where my client has earned more than $190,000, and that puts him up at the top of the tax bracket. All right, so any dollar he earns above $190,000, he's going to get taxed 45%. All right, so I earn $1, I keep 55 cents, and I've got to pay 45 cents in taxes, which is a bit draining. Okay, so what we've done here is we try to reduce his taxable income as much as possible so he doesn't have to fork out that 45% tax. And what we've recommended working with his accountant is we offered him an interest in advance loan. But not as much people do this because they don't understand how it works. And today I'm going to break it down for you how we just reduce his taxable income and his tax liability by just under $45,000. And let's break it down. So this client of mine, he's in sales and he's always earned around $220,000 a year. Now his base salary was around $120,000. So anything he earned above that was always commission because he's always in a sales role. Now, however, last financial year, in 2025, he closed a massive deal where he got paid an extra $150,000 in bonuses / commission. So his normal salary, including commission, is always around $200,000 to $220,000. But now his taxable income, his income earned from this. So his income earned, excluding this $150,000 for 2025 financial year, was $210,000. But this massive check came in midway through the financial year, was $150,000. So this $150,000 plus the other $20,000 that he made on top of the $190,000, he had to pay 45% tax on it, which is a big killer. So what we did is we done an interest in advance loan to reduce his taxable income, and that's how I reduced his tax liability by just under $45,000. Okay, so before I break it down, I want to tell you what an interest in advance loan is. This is generally done if you earned a massive income, bonuses, commission for that financial year. You're not going to earn as much of an income the following financial year. Okay, now, so what an interest in advance loan is, I'm going to pay my interest the following year forward. So for example, when we done the interest in advance loan for our client, it was a 2025 financial year. But what we've done is we restructured this loan and we paid all the interest that he was going to get charged in 2026 forward in 2025. And why did we do that? Because all his investment loans, the interest charge is tax deductible. Therefore, it allows me to reduce his taxable income. Okay, and that's how we're able to save a lot of taxes for him. And I'm going to show you what we've done for him with his accountant. Now, I'm not a tax accountant, and if you want to go down the interest in advance loan, you should always talk to your accountant before you proceed with this restructure and want to pay the interest upfront 1 year forward. So everybody, if you're just listening to this podcast, please just jump onto the YouTube video because I've got a whiteboard right here that breaks down a little bit more for you. Okay, so as I mentioned before, without that massive commission check, his taxable income for that financial year was around $210,000. So anything above $190,000, he was going to get taxed 45%, especially that $150,000 he received. He was going to get taxed 45% as well. So for that $20,000 that he made above 190, at 45%, he was going to get taxed $9,000 for it. Okay, and on that 150,000 at 45%, he was going to get taxed $67,500 for it. All right, and that's actually a lot of money taken out of his paycheck when he got paid that $150,000. Right, look, that $9,000, give or take whatever it is, right? But that 150, that's the killer right there. So how do we reduce his taxable income and reduce this tax liability? Okay, so what we did was we done that interest in advance loan where we paid all the interest in 2026 financial year in 2025. So his loan amount was $1.62 million at 6%. Okay, So the total interest that he was going to get charged for the 2026 financial year was going to be $97,200. So what did we do here? We actually paid all this in 2025 financial year. So that minus that equals to $52,800 because I've actually paid all that interest in advance. Therefore, because it's an investment charge for investment purposes, I'm actually allowed to claim this back to reduce my taxable income. Okay, for people that have investment loans out there, it's pretty much what you call negative gearing, right? So you can claim a lot of this. So you can claim a lot of the interest back because your interest charge outweighs the rental income received. Therefore, anything that you paid above there reduces your taxable income. All right. So therefore, instead of getting taxed at $150,000, he's going to get taxed $52,800. All right. So I can see here the difference now is at 45% at $52,800, your tax liability would only be $23,760. So that's a big difference of around $43,740. Okay. And therefore, because we restructured his loan and we paid all that interest in advance, well, guess what? He's going to save himself around $43,740 in taxes, all right? Or he's going to get that back at the end of the financial year when he does his tax returns, which is not bad, right? So yes, he did pay it, but you know what? He's going to get that tax return back. So instead of paying, $67,500, he's going to instead pay $23,760. Yes, a bit of this will be offsetted in the following financial year, but you know what? He did this because he understands that in the 2026 financial year, he's not going to get this $150,000 commission check because this was a once-off massive sale for him. That's why it was abnormal for him to receive this, and that's why this strategy worked well for him with consulting with his accountant first before he even did all this, right? But everyone, this only works when you know you're going to make a lot of money in this financial year and not as much the next financial year, all right? Because if you're going to make the same amount of money in the next financial year, well, there's no point in doing an interest in advance loan because your tax bracket is still going to be the same. So the biggest downfall with doing an interest in advance loan is the rates, okay? So when we done the interest in advance loan in 2025, the rates were 6%. Now it's 2026, and guess what? The rates dropped 25 points. Okay, and guess what? We're going to probably see another 25 to 50 point drop by the end of the year, all right, or end of the financial year. So therefore, he's actually losing out a bit right there because he paid the interest at 60%. But really, if we average out in the following financial year after the 1 rate drop or even 2 rate drops, it's going to be around 5.5 or let's call it 5.75. Okay, so he's paying a little bit extra on the interest right there. Okay, that's the only downfall I see in regards to doing an interest in advance loan. But like I said to you, this is only viable if you're going to make a heck load of money this financial year compared to the following financial year. So remember everyone, this is not tax advice. I'm not a tax accountant. You should always talk to your accountant before you want to go down this strategy. This only worked, and this is what we did for our client on the consultant and on the agreement with his accountant. As always, thanks for joining me on another episode of the Mortgage Chat. Peace.